Good evening, everyone. Thank you for joining us today. I'm Janet, the VP of Investment Advisory at Stashaway. Here I am together with Stephanie Learned, our CIO at Stashaway. Today we will actually by sharing, Stephanie will share her insights into our current economic landscape and what is the recent political changes in US environments would means for the markets and our investment. Before we start, for those who are not familiar with Stashaway, let us do a quick introduction. We are actually Singapore HQ digital wealth platform here operating in Singapore, Malaysia, UAE, Hong Kong, and Thailand. We are backed by blue chips investors, including Fidelity and Sequoia. We are here in Singapore since 2017, about 8 years. And we are offering a wide range of platforms, including cash management, core portfolio, thematic portfolios, and alternative, including PE, VCs, and angel investing. And here's give you some screenshot for how does our platforms look like. It's easy to use, transparent, cost efficiently platforms here to build you a long-term wealth together with you. Next, Stephanie will walk through you for all the economic landscape, and after that, I will share with you for what we can do to make your most of today's opportunity. And let's start with, let's hand over to Stephanie to begin. Thank you.
Thank you, Janet, and thanks everyone for being with us tonight. So as you all kind of have seen, Trump has had a landslide win in terms of the US election. So today we're going to dive into, what are the impacts from the election, from particularly looking at three major, sections. So first of all, of course, there has been a lot of market reaction already. So first of all, let's take a look at what those market reactions are and what we can learn from those. Then, of course, the meat of tonight's presentation is, what does that mean actually for the economic growth and also inflation picture going forward? And lastly, which is something that I guess a lot of you are asking, how do we play, right? Given all the insights, how do we position our portfolios for the next 4 years of the Trump presidency? So first of all, let's go into market reactions. Now, I think all of you have been reading the news, and it was very, very apparent that Trump had won both the electoral vote and also the popular vote. So in the U.S., for those who are not familiar, there's in the U.S. election system, you not only have to win more votes, you actually have to win more states, and each state actually have a different number of votes representing the state. So a president gets elected by winning the electoral vote, which means that the states you won the state's vote. However, Trump, what was actually quite remarkable about the Trump win was that he also won the popular vote, and by a pretty significant margin as well. So that has not happened for a long time. This is a chart that shows you, you can see a lot of red triangles. And the triangles actually show you the differences of the election this time versus the election last time. So each rectangle actually represents a gain in votes for the Republican Party in the presidential campaign or presidential voting. And you can see that clearly on the on the right-hand side, a lot more states on the East Coast have voted for Republican, have voted for Trump. Also, I think from a kind of, if you look at the Senate and the House, the Republican Party have actually won both. So, this is what we call a red sweep, in the sense that, basically now that Republicans control the White House, the Senate, and also the House. So, this actually means that any of the Trump policies or any of the Republican policies now would actually have an easier time to getting passed, whereas in a kind of much more, fractured or even split government, the policies, the enactment of policies actually have a much lower chance. So this, all in all, has been a landslide win for Republicans as well as for Trump. If we look at also U.S. Asset returns on election day, we can actually see some pretty interesting, I guess, insights. So of course, we all knew that the U.S. equity markets reacted very, very positively in the sense that, of course, S&P was up 2% on the day, and there was some follow-on as well on the day after. However, if we just look at the percentage change, that may not give you the full picture. So here we look at the movements of different asset classes by its standard deviation. So if you look at the, like, I guess the bottom, the x-axis of this chart, you can see that I've labeled it SD move. What is SD, right? It's basically a number that represents a normal movement of a particular stock or ETF or asset classes. So take, for example, if you look at Bitcoin, of course, I mean, Bitcoin moved up a lot, right? Today it's actually above 80,000 or 82,000. But because Bitcoin actually moves a lot more, even on a normal day, so you actually have to adjust for that move to see exactly, I mean, how much Bitcoin reacted to Trump's election result, and to make a fair comparison versus things that don't move that much, for example, U.S. Treasuries. So what I've done is to normalize all these different asset classes in terms of the number of standard deviation. And if you start from the top, you can see that what has performed the best on election day was actually U.S. banks. These banks have had an 8 standard deviation move on one day, which means that they moved 8 times of what they would normally do on a normal day. Followed by that, it was U.S. infrastructure, and then Russell 2000, it's a small cap index. And then also, actually, interestingly, the dollar actually moved up quite a lot, right? The dollar had a 4 SD move on election day. And then it was followed by Bitcoin and S&P. So both, even though, I mean, Bitcoin moved a lot more from a headline basis, actually, it was quite in line with the equity move. What didn't do so well, right? For example, if you look at the bottom of the chart, gold actually had a -4 SD move on day. So gold, there was some profit taking, given that, I mean, we all know that gold has been performing very, very well this year into the election. And I think there was some positioning ahead of the election into gold. The second thing from the second, I guess, asset class from the bottom is actually long duration bonds. And long duration bonds or long maturity bonds actually had a -3 SD move, followed by Hang Seng Index, the Chinese equity market, and then also by FTSE All World ex-US, which is the equity market excluding the US. And oil actually had a very, very muted response. So you can see here that, I mean, basically what has been coming out on top are some of the more domestic and some of the sectors that are more aligned with Trump policies, which we'll talk about later. The other thing that happened was basically you look at the other way to look at equity market is through the lens of the VIX index, what the market currently implies in terms of near-term volatility. And for those who are not familiar with the VIX index, it's spelled VIX. It's the other name of the VIX index is actually called the fear index. So the higher this index goes, the more it means that the market is actually worried about a correction. Now, you can see that there was a spike in kind of early August, and that was when the market was quite worried about a U.S. recession. Of course, a U.S. recession didn't come, as we were talking about at that time, but the market was actually quite nervous about the election. So as you can see, I mean, basically right before the election, VIX was spiking again. And what happened post-election? Of course, I mean, markets, as we always say, markets hate uncertainty and they like certainty. And one of the outcomes of the election that we feared the most before the election was that there was no clear outcome. And that could mean that this election drags on for quite some time. And that would also have drag-on effects on manufacturing and growth, given that there's still a lot of concern about who's going to be in the office after the election. Now, what happened after the election results were out, I think that was a surprise to a lot of people, was that the results were out much faster. And of course, like volatility collapsed afterwards. So, I mean, market is saying, okay, I mean, we've got a result. It's Trump in office, so we can move on. If we look at the difference in returns in terms of style, is also quite interesting. So here there are different styles of equities. So for example, on the top, you can see that value and volatility actually outperform. And it's interesting to note that on the bottom are big caps and quality. So there's a bit of rotation out from quality defensive big cap names into small cap value, things that are, I guess, much more indicative of a upturn in the economic cycle. So in all, I mean, the equities market was saying, okay, Trump is going to bring in more growth. So, I mean, that is what the market was saying on election day. So, I mean, it's worth for us to kind of dig deeper and to look at, I mean, what are the actual policies that Trump has proposed and how likely is he going to enact these policies? And of course, like, what does it mean for growth and inflation? So, as I mentioned before, in August, the market was actually quite worried about the recession in the summer. And this is a simple chart that shows you the Google search term for the word recession. And you can see that there was a spike in August. And if you roll back a few months ago, it was still quite fresh in our memory, the concern was that there was a slowdown in some economic data, as you can see here. And also there was a concern about rising unemployment. So if we look at what the data actually said, I mean, here is a chart that shows you 3 lines. So the 3 lines, you can notice that, I mean, they kind of move in the same direction most of the time, but recently the yellow line has been much below the other 2 lines. So these 3 lines are all PMI indexes, what we call the Purchasing Managers Index. And these lines actually represent some forward-looking survey that was sent to purchasing managers in different industries. So every month, the S&P does this survey, and they collect the results of these surveys. So the simple way to read this chart is that if the reading is above 50, it means that, I mean, things are actually quite good. Things are expanding. Business managers are quite happy about the future. And typically it has coincided with a pickup in activities. So good to be above 50, even better to be above 50 and also rising. What's not so great is below 50, of course. Below 50, typically, I mean, these are times when there's an economic contraction, and I mean, they sometimes, of course, like when the drawdown is quite deep, they coincide with recessions. And you can see that the yellow line has been sort of like chopping around, and I guess in 2022, both all 3 lines were below 50, and that was when we had the slowdown and when we had this stagflation regime. Today, we only have the manufacturing index below 50. However, the below 50 was enough to cause quite a lot of concern about the market, the growth ahead in different markets. And also it was part of the triggers for the Fed to cut interest rate by 50 basis points. So was the economy actually so weak? One way to look at it is to actually dive a little bit deeper into the survey and see what are the managers actually saying. And when we looked at the commentaries that come with these numbers, because I mean, a number is just one number, but I mean, why, right? You need to kind of understand why. What we found out is that a lot of companies, a lot of like these managers are pointing to the uncertainty caused by the election. Because if you think about the Trump policy and the Harris policies, they are actually quite different in a number of ways, and they affect different industries in very significantly different ways. So if you put yourself into a CEO's shoe, of course, with the election outcome just a few months away, you would probably hold on to your hiring plans or your investment plans. So when CEOs or when managers are holding on to their investment plans, of course, it has ripple effects to the whole supply chain. So we think that actually a lot of the weakness in the last few months is caused by this uncertainty. And indeed, when we look at business expectations, a lot of these managers actually expect business to pick up after the election results and in the beginning of next year. So, I mean, this is one sign that, I mean, what we've seen is actually quite temporary. And the reason why the VIX, the fear index, actually collapsed after the election is actually saying something about forward growth being much better. So I guess if we look at the policies itself, this is a very nice slide that summarizes the 6 key pillars of Trump policies, and I mean what their impacts are on both growth and inflation. So let's start from growth, and let's just go through the policies one by one in a bit more detail. So of course, I mean, Trump has been talking about tax cuts. I mean, Harris has been talking about tax cuts as well. But the main difference is that the Trump taxes are much more pro-business. So as we all know, Trump is going to extend his previous tax cuts enacted in his 2016 term. He also floated the idea of cutting further the corporate tax from 21% to 15%. Now, of course, there's a lot of question as to whether or not he can actually cut it to 15% because it's a pretty dramatic cut. However, I think number one, with kind of the Republican sweep, there's much more possibility. And even if he doesn't get it to 15%, maybe he can get it to like 18%, 17%. I mean, that still represents a significant increase in earnings growth for US companies. Because the way you think about tax, tax actually comes at the bottom line. So every 1% tax in a cut in the tax rate actually goes directly to a company's profits. So, for example, if it manages to cut 3%, that means that the S&P as a whole, or U.S. companies as a whole, will get a 3% earnings boost. And as you all know, when we buy stocks, when we buy equity, we're buying earnings. So, I mean, that has a direct translation effect on asset prices. And I guess the other side of this is that if Harris actually won, then I mean there is a risk that the Trump tax cuts would not get extended, and that is quite negative for corporate earnings growth. So tax cuts are definitely pro-growth. Second key pillar is deregulation. So I mean, there's still a lot of details that are not I guess not discussed or not disclosed, but in general, I mean, Republicans are much more pro deregulation, and these regulations actually would impact some industries of course, like under strict regulation that includes bank, industrials, and also infrastructure companies, energy trading companies, etc. So if you kind of remember a few slides ago, I showed you what are the top sectors that came out on election day. I mean, those are exactly sectors and companies that benefit from deregulation. So it is also quite pro-growth. Third, tariffs. And I think this is a very interesting topic because, of course, Trump has been calling himself tariff man, and he seems to be quite determined to impose tariffs on his trading partners. And the numbers that he floated around is sort of 10 to 20% on all imports. That includes everybody, even the US allies. And of course, he is targeting China as well. So the number is floating around for 60% higher rate for Chinese imports. Now, this is obviously not great for growth because it would kind of slow down trade and also make things much more expensive, which I guess which is something we can talk about when we go to inflation. However, I think there are a few things that we can sort of take a bit more comfort with in terms of what actual tariffs are going to be implemented. Number one, judging from the 2016 experience, we think that actually, I mean, Trump has been very, very big on talks, but when he actually delivered the tariffs, it was actually much more targeted. So, for example, 60% interest tariffs for China, they may not apply to all Chinese imports, but maybe he can select some of the kind of least the imports that are least I guess least strategic or least impactful for U.S. consumers. Secondly, I think if you look at the other trading partners, they actually have a lot of tools to counteract a tariff. And one very, very important tool is actually the currency. So if you think about a import, of course, you spend US dollar and you buy imported goods. And if the US dollar actually appreciates by the same amount, let's say if Trump slaps on a 10% import on all goods, but the US dollar actually appreciates 10% versus its trading partners, net, actually, there's no difference in terms of the price that a consumer would pay. So currency is actually a very powerful tool to counteract tariffs. And this is what we've seen in 2016 that kind of mitigated some of the impacts from higher tariffs. And potentially, I mean, we can see that happening this time around too. And lastly, I mentioned about Trump talking kind of a lot about tariffs, but I guess at the end of the day, he has a group of advisors advising him on what actually to implement. And back in 2016, we have some very hawkish advisors like Navarro, who had been studying tariffs and who are true believers in tariffs. I mean, today, who do we have like next to Trump? It seems like people like Elon Musk are what he calls like the biggest stars right now. So, and we all know that Elon Musk has a lot of businesses elsewhere, and most notably, China is a very important business kind of, I guess, interest for him. So if he were to advise Donald Trump, perhaps, I mean, they would give kind of much more business-friendly advice on in terms of tariffs, and so mitigating the negative impact on growth. Fourth, immigration. And I think actually compared to tariff, this is an area that did not get a lot of so much media attention, but it potentially is a much more negative for growth compared to tariffs. The reason being, I mean, Trump has floated around some numbers, but I mean, the final number it could be quite significant, or I mean, it could be much higher than 150 number that has been floating around. But I think the reason why immigration is so important is because if we look at U.S. growth in the past 12 to 18 months, and if you look at the data on employment, actually the U.S. benefited a lot from immigration, a lot from imported labors. So if Trump was to enact a large-scale deportation or kind of further restrictions on importing labor, I think that places a significant kind of headwind to U.S. growth. Of course, I mean, he has businessmen as part of his inner circle this time. So hopefully they would give him kind of more pro-business advice. But I mean, I think as an investor, this is actually an area of risk that we should be looking out for. Lastly, on defense and energy, I mean, Trump is most likely going to push his I guess his NATO partners to spend more on defense. And I think, I mean, if we look at kind of the trends in terms of defense spending, it's been on an uptrend already for I guess at least in the US and also in other countries. So we expect, I mean, this trend to continue. I mean, it's slightly positive for growth because when I mean governments actually spend money, they tend to boost growth and with the money that they spend. So it's a positive. Lastly, in terms of energy, again, going back to deregulation and also kind of putting in place more supply, typically, I mean, that is also quite good for growth as well. But these are the 6 key pillars of the Trump policies announced so far. And I think if you take kind of the net of all these policies, they are quite pro-business and they're quite positive to growth. So we all know that these are policies going forward. Now it'll take time to implement, it'll take time to play out. But if we look at the nearer term, what the other factor that is also very important is, of course, liquidity, like how much money is actually in the system to buy risky assets. So this is a chart that I borrowed from our good friends at JP Morgan, and it shows you the stock of US money supply measured by M2. So it's basically how much money is going around in the US economy. Now you can see that there's clearly a change in trend, and for a better part of 2022 and also into early 2023, liquidity was actually contracting. So there was fewer dollars going around the economy, and that partly explains why during that period actually equities didn't perform so well. And of course, a lot of the tech names with high valuations got impacted because there was less money going around. Since then, actually, even though the Fed has been tightening policies, actually they have started also injecting much more liquidity into the system. So since the mid 2023, liquidity has actually been rising. And of course, we all know that the Fed already cut 50 basis points at its first rate cut and another 25 basis points just last week. We expect them to cut another 25 basis points as well by the end of the year, bringing the total to 100 basis points. So the Fed is clearly in loosening mode as well. So this kind of increase in money supply, combined with the Fed's kind of much more easing bias, means that liquidity will be quite supportive for risky assets, at least in the next few months. So we talked about all the great things that Trump is going to do. There's actually one big question mark. All this actually requires money. So who's going to pay? And if you just take away one chart or one key chart from this presentation, I actually think that this chart is worth referencing to from time to time over the next 10 years. So this chart actually shows you the U.S. government's borrowing, because the one way for the government to increase its spending is, of course, try to increase its revenue. But if its revenue cannot catch up with its spending, then basically the government has to issue debt, and this is U.S. treasuries that the U.S. government would issue. And when we look at the Trump's plan, basically it means that the U.S. will have fiscal deficits over the next 10 years. So what does this do, right? This actually increases the debt burden of the U.S. government as a whole. So if we look at where it is today, so this is a number, this ratio basically is called the debt to GDP. And I mean, to think about this number is actually, you can think about yourself as a country, right? That is basically how much you owe. It can be, I mean, to a bank, your mortgage, etc. Everything that you basically you owe, right? And GDP is basically how much you earn per year. So the U.S. now is basically running about 100%, meaning that, I mean, the debt that they have is worth 1 year of their earnings. So I mean, it's actually quite a big debt burden. Remember, this is not mortgage, right? You don't have any collateral. It's just like the good faith of the U.S. government. So imagine, I mean, you using your own good faith and going out to borrow money and borrow up to a year of your earnings. So I mean, this is the way to think about it. And I mean, looks what's going to happen. I mean, it's in a base case, right? If under the current situation, so by the year 2035, the U.S. debt to GDP would rise from 100 to 125. I mean, it's still high, but it's not as bad as in a Trump win. So with all the Trump policies, like the tax cuts, the I guess the all the I guess tariffs and all the kind of deregulations, I mean, it is projected that this debt to GDP will actually rise to 143%. And this is a forecast that is done by the government itself. So basically, we're looking at a significant increase in the debt of the U.S. government. And I mean, the reason why I say, I mean, this is actually a very, very key chart to remember, because it affects how you think about different asset classes for the next 10 years. Because remember, the U.S. actually sets the risk-free rate. And if U.S. debt supply actually increases and there's not I guess a similar increase in demand, that means that U.S. interest rates could actually stay higher for longer or even like go higher. So this is one thing to remember about a Trump presidency and the policies that he's going to enact. And of course, the other thing that would impact interest rates is inflation. And that's why, I mean, we also have to look at the inflation side of things, right? You get good growth, but also, I mean, you may have to pay in terms of high inflation. So again, let's look at it one by one. So let's start from the top in terms of tax cuts. And if, I mean, it's stimulative to growth, more money going to the corporates, they're spending more money, that would be good for, that would be supportive of inflation. Of course, this is sort of like I guess a good inflation in a sense that, I mean, you have inflation with higher growth. I think deregulation is sort of neutral, so we put like a question mark there. Tariffs, we all know, and I mentioned it, it's actually, I mean, potentially increases prices paid. So typically, I mean, it would support higher inflation. However, as mentioned, I mean, this impact may be a little bit overblown, and let's see, I mean, what actual tariffs Trump would actually come up with. The policy that is actually most, I guess, that would cause the most inflation worry is actually, again, immigration. Because if there is a large-scale deportation. I mean, it already in the US, the labor market is quite tight, as we've mentioned in the past 2 years. And if immigration get tightened, that could tighten the labor market again and put upward pressure on wages. So, I mean, this is definitely not great for controlling inflation. So I think from a inflation point of view, again, I mean, immigration policies is something to closely watch. For defense and energy, I think in general, I mean, more defense spending, of course, it creates more demand, and that's why it would create somewhat higher inflation. On the last point on energy, that is potentially negative inflation because it could potentially create more supply in terms of oil and energy sources. However, if you take kind of net in terms of the Trump policies, it seems like, I mean, they would support higher inflation for longer. So let's look at also what the market is pricing in right now, right? Because we're saying, okay, I mean, the Fed is cutting interest rates. So what about next year? Because we're already quite close to end of the year, and the interest rate path next year is actually much more interesting. So here we see something called the dot plot. And of course, you see a lot of dots. And each one of these dots actually represent a Fed voting member. So when the Fed members vote, they also make a projection for where they think growth, inflation, and interest rates are going to be. And the market likes to look at this dot plot to see kind of like what the Fed is projecting to take reference. So when you look at all these dots, of course, they're quite dispersed. So we also like, as a convention, to look at the median or the sort of like the average. And you can see that average in the green color line. The other line that I'm showing here is a black line, and this is what the market is pricing in via Fed Fund futures. Because I mean, the market actually trades all these expectations all day long as well, so we can easily extract information from that. So let's start from 2024, and I mean, of course, like there's still only one Fed meeting left, and I think the Fed is projecting itself to cut another 25 basis points to just slightly below 450. The market has been somewhat more aggressive, but I think actually is a very, very little chance that the Fed will actually cut more than 25 basis points. What about next year? So next year, the market and the Fed are both expecting about 100 basis points of interest rate cuts. So to put 100 basis points into context, I mean, that is basically 4 times of rate cuts. And post the 100 basis point rate cuts, I mean, that would get interest rate down to below 350. So I think in terms of the risk of high inflation is that the Fed or at the end of 2025, towards like the second half, perhaps, I mean, the Fed would have a much trickier path to deal with when they want to cut interest rates further, because their target is actually to get inflation down to 2%. And the reason why they started cutting interest rates was that they're confident that interest rates that inflation is on the way to 2%. Now we see kind of a plateauing of inflation or even an increase in inflation at some point next year. I think that would complicate the Fed's job to further reduce interest rates. Another interesting observation is that I mentioned about the U.S. fiscal situation in 10 years. So, of course, to fund the next 10 years of spending, the U.S. government issues 10-year treasuries or even longer, like 20-year, 30-year treasuries. And one thing that is quite interesting is from this chart, you can see, I guess what this chart shows you is from day one of the first Fed cut, how has the 10-year treasury note changed in terms of yield? So has it yielded higher or lower? The black line is the latest, I guess the latest Fed cut. And you can see that even though the Fed cut interest rates, 10-year treasuries actually, the interest rate of 10-year treasuries actually increased. So in a very counterintuitive sense, interest rates for the long term increased when the Fed cut interest rates. That is actually the first time it has happened in I guess going back all the way. This chart goes back to like 1995 or 89. So in all the other, I guess, Fed cut cycles, long-term interest rates actually fell with the rate cut. So, I mean, the market is sending a bit of signal that, I mean, they are worried about the long-term fiscal condition of the US government. So I think that wraps up our kind of interpretation on the effects on growth and inflation. And again, for those of you who are familiar with ERA, basically, I mean, this is the ERA cycle. And I guess ERA has a full regime framework, and it's divided into positive growth, negative growth, low inflation, high inflation. So today, I mean, we're in high inflation, positive growth, which is called inflationary growth. And we have actually been in inflationary growth since April this year. Now, if we think about the Trump policies of what I've mentioned before, they are good for growth, but they are also supportive of inflation. So what does that mean in an ERA context? It means that we are perhaps more likely to stay in inflationary growth for longer. And ERA is actually quite well positioned to capture this regime. Of course, I mean, ERA monitors real-time economic data coming in sort of every month. And if we see a change in the regime, then ERA would trigger a reorganization. But if we have to make a projection of where we see ERA going, it's quite likely that we're going to be staying in inflationary growth, given the Trump policies. And the other question is, what are the themes to play, right? We've mentioned a lot of different policies. And again, I would refer back to day one performance of these different kind of sectors to give us some clue. Because I do think that a lot of these actually may be able to continue in the near term. And if you look at day one sector relative performance, you can see on the top, again, regional banks, oil and gas equipments, capital markets, transportation, et cetera, et cetera. So what are the themes here? I've summarized them on the right-hand side, so it's easier for you to sort of digest. These themes are reshoring. I mean, basically bringing manufacturing back to the US, deregulation, as we spoke about, tax cuts, and also lastly, cyclical recovery, because the market is expecting actually better growth. So what's on the bottom? We can see that on the very, very bottom, that's real estate. Real estate actually fell on the day because of the increase in long-term interest rates that will increase mortgage rates. One of the other sectors basically are defensive sectors like utilities, staples, etc. So clearly, I mean, there has been a violent rotation on day one. And if we look at positioning, these themes are not yet crowded. So a lot of these themes actually have not worked out in the last 12 months. So, I mean, I think it's the beginning of some sort of rotation back towards some of the more cyclical recovery themes. In terms of ERA, given the inflationary growth, we have actually allocated more to equities, and we've also maintained our allocation as goal in April. Basically, what we did was we said we would put cash to work, and I mean that has worked out quite well. And based on all these themes, like how is ERA positioned, and how can you also position for capturing more upside? From an asset class kind of top level basis, continue to overweight equities and gold and underweight bonds, given all the reasons that we've talked about. I mean, equities tend to do well in a growthy environment. I mean, gold gives you protection on the higher for longer inflation regime, and long duration bonds typically, I mean, underperform in this sort of regime. In terms of geography, we have a clear favor of the US over Europe, and we continue to do so, particularly given the uncertainty in the tariffs. So I think also if you look at fundamental data in Europe is a lot weaker than the US data. US economy is actually quite strong, and with the Trump policies, it could be even stronger. We also favor Japan and India. I mean, these are much more domestic stories, reform stories in Japan, and also India is one of the best countries to look for economic growth on a long-term basis. So data continues to support these two theses. On China, we remain market weights. There's been a lot of course, policies coming up from China. And I mean, most recently, they sort of announced a 10 trillion number. I think the market was slightly disappointed because there was a lack of detail into what are the actual stimulus. And I think one of the things that we were looking for, at least, is more detail on, I guess, stimulus in terms of consumption. So directly putting money in people's hand and getting them to spend. Because I think what's in China, the liquidity is not a problem. So the Chinese system actually don't need money. They have a lot of money. The problem is that nobody is spending either from the consumer side or from the business side. So the government needs to really, stimulate the spending. In terms of sector, what we have been kind of positioning for is the broadening out of US equity rally. We're all very familiar with the Max 7, but there's still like the 493 names on the S&P. So that's one good way to play the Trump rally. Already we're seeing outperformance in terms of small caps. We have allocations to equal weights at S&P and also some cyclical sectors like industrials. Secondly, aerospace and defense, sort of is in sync with the Trump policies on defense. And then lastly, in terms of healthcare, as a kind of defensive sector and a sector that doesn't benefit as much under a Trump administration than a Harris administration. We have pared back exposure in April. So that has sort of benefited the portfolios as well. So wrapping things up, this is a chart that shows you how ERA positioning has helped investors to mitigate the drawdowns and also to outperform kind of over a cycle. So here's a chart that shows you the two lines from beginning of 2022. And basically, beginning of 2022 was when we had the inflation scare. So the markets were down quite a bit, but then subsequently recovered. So this kind of past cycle about inflation. So the darker line is a average general investment portfolio performance, and the lighter dotted line is our same risk benchmark average. As you can see here, the stashaway portfolios have outperformed our benchmarks on the drawdown. So we have protected our customers' money in line with the risk appetite, in line with the SRI that has been chosen. And subsequently, we have also rebounded more than the benchmark's average. So cumulatively over the whole cycle, since Jan 2022, stashaway portfolios have outperformed our same risk benchmarks on average by about 6.7 percentage points. And of course, if you're so skillful or so lucky enough to have bought at the bottom of in the fourth quarter of 2022, you would have made on average 35% from lows from a stashaway portfolio. But of course, this is sort of looking at the past. So what about the future? I'm getting a lot of questions about the concern on all-time high. So a lot of people, when they look at like what's happened, they were like, oh, damn, I have missed that 35%, and I am now looking at an all-time high. So the question is it too late to chase? Am I gonna just buy at the top and have to suffer a drawdown? So I'd like to just share two charts or two what I call investment truths. Number one is that all-time highs happen all the time because equities or bonds or gold, they tend to go up over the long term. So you would run into all-time high a lot of times. And if you see all-time high, it doesn't mean it's too late. It doesn't mean that you can't have another all-time high. And indeed, if I look at the S&P index is shown here, and it goes back to 2016. I've shown you here, 4 arrows. Basically, I've drawn the arrows all from a fresh all-time high. So for example, in 2016, S&P reached an all-time high around June. So since then, what has the S&P done? It has continued to rally for another year and a half, and it basically ran up 21% from that all-time high. So there were a year when there was actually more all-time highs than that all-time high. So similarly, in 2019, there was an all-time high. The index actually went up another 20%. In 2020, post-COVID, there was another all-time high, and the index ran up almost 30%. So today we're in the 2024 cycle. Of course, we've had multiple all-time highs, and we're now up, I guess, close to 30% from the all-time high from 2023. So is it too late to buy into all-time high? I mean, only time will tell, but what I'm saying is that, I mean, all-time high doesn't mean that it can't be followed by all-time high. Indeed, I mean, a lot of times it is followed by all-time highs. So the other question is, or the other investment truth is, even if you invested in all-time high and is the worst absolute timing, it doesn't mean it's the end of the world, because this is a chart that shows you the S&P performance going back all the way to the GFC, 2007. So if somebody is so unlucky to have bought at the absolute high, that was right before the GFC, during the last month of 2007, that person would have had a pretty tough time for about a year and a half, when the S&P actually fell 43%. However, if that person has picked a right risk level, meaning that he or she was fully expecting, or I mean, if he or she can't take a significant equity drawdown, and chose a relatively kind of a SRI that is in line with the risk appetite, then, I mean, over the next 20 years, actually, no, 17 years, you would have recovered. And even if you bought S&P at the worst timing and had to suffer that 43% drawdown, after 17 years, you would have actually made almost 3 times from your investments. So even if you made the worst timing in the near term, it doesn't mean that is the end of the world. Because if we think about why we invest in asset classes like equities or bonds, these are I guess, for example, for equities, we're investing into economies and companies that would grow earning over time. And when they grow earnings, I mean, you would grow your return on the asset class as well. So this is, of course, like the worst case example. And somebody has to be really unlucky. And I hope it doesn't happen to any one of us. But this is to show you that with time, you can actually make your money back and some more. So maybe I'll stop here, and I'll let Janet take over and walk us through how do we put insights into action.
Thank you, Stephanie, for sharing your insights on how the elections and policy changes can impact the markets. I mean, we can see that there are both opportunity and challenge ahead. Understanding this shift can only help us to make some smart decisions. You know, with the rate cut cycle continues, inflation pressures rising, and a focus on the business growth, knowing all this is just the first step. Now we're going to look at how we can use this information to make the best choice for our portfolios. In my part, the next 10 minutes, we're going to go through some specific actions that you can use, take with a stashaway portfolio. Let's look at the cash holding that you have. While you're as interest rate may continue to drop, as what Stephanie has highlighted earlier, meaning that the cash return actually is likely to decrease. So what does it mean when you're holding too much cash? Holding too much cash could mean that you're missing out a lot of potential gains in these areas of the post-business, the area that are beneficial from the post-business policy, especially when inflation would eating up away at your cash value over time. So for those that with a long-term goals, moving cash into a general investing by Stashaway actually can give you the access to diversify growth asset positions to capture these potential gains. And then the action that we actually can do is that instead of really pick a one time to pick a put lump sum into the portfolio, you can actually, a great way is actually you put your cash into the Stashaway US cash shield portfolio, which is actually a 0 to 3 months T-bills treasury, which still currently giving you a 4.5 yield to maturity returns yield in this portfolio. At the same time, you can arrange some integral transfer from this US cash shield and different frequency to transfer into a general investing portfolio. With that, you are not only performing a dollar cost averaging strategy, at the same time, you are actually time in the market, and you can actually, all this idle cash that putting inside the portfolio actually help you to generate interest while you're waiting for getting into the portfolio from over time. And next, with the inflation expected to stay high, because equity and gold has what mentioned by Stephanie earlier, that would offer valuable opportunities within a diversified portfolios. These pro-growth policy are likely to support the sector like energies, industrials, infrastructure, making equities in these areas a strong position for growth. Then how can we going to be taking part into it? Actually, within the general investing, is already have this current equity and gold positioned for you. And then it depends on your risk profile. We have offered 12 different risk level, which provide a balanced mix of equity, bonds, and gold at different risk level. And if you actually have interest in the specific sector that highlights earlier in our sessions, you can actually use the flexible portfolio, which can pick the particular asset class from that where would you believe that it would we have mentioned, and you believe that it will benefit from this policy, like energy or infrastructures, and for use to continue to invest. Again, this also can offer you the intergo, which is inter-portfolio transfer. You can put your money into US cash shield first, and then subsequently you can arrange a regular transfer from the cash short-term duration, short-term T-bills portfolios, and slowly move it to the growth asset. And of course, if you already have your own portfolio and you wanted to add on to gold as inflation protections, this asset class is also available under a flexible portfolio. Next, how do we really look at the fixed income? I mean, equities are excellent for growth, but actually fixed income is also crucial for those who want a steady, reliable income stream, and also it acts as like a stabilizer in the portfolio. I mean, only because of the inflations that continues to stay for a while, it actually would be negative for the long duration bond. And this is exactly why sometimes you wanted to, when you're adding into a fixed income portfolio, as fixed income into your portfolio, you wanted to focus on the duration with the relatively short to medium term during this periods. And in Singapore, we actually have offer income investing portfolio, which managed by powered by JP Morgan Asset Management. This actually designed for portfolio that has a mix of different durations and across all the credit from EMs to high yield, and then investment grades, and give you a short to medium durations portfolio. And which currently is a zinc hedge portfolio yield is around 4.1%, which has already considered after deducting the management fee and the zinc hedge cost. This portfolio will be able to provide you the income for a stability for overall portfolio. And for the professional investor, accredited investor, they can also even consider the senior private credit as one of the alternative asset into their portfolio as part of the attractive and consistent yield, which also help to increase their risk-adjusted return. For those countries that they wanted to take part into the fixed income as part of the stabilizer, and they can also go into the flexible portfolio. There will be a passive income template that they can leverage on, or they can also look at different sub-asset class to choose the corresponding asset class for them to add into their portfolio. Last but not the least, an efficient portfolio actually maximize growth while minimizing unnecessary costs. Our portfolio actually would keep all the investment cost efficient, while the tax awareness also help our clients to remain more of what they earn. So in Singapore, all our portfolio actually would be also available for both cash and SRS, which is the supplementary retirement scheme. So other than all the private markets, the rest of the portfolios are all available for SRS. So for those who are in Singapore, they are not only be able to save tax for contributing to the SRS account, at the same time, they can also use our cost efficient portfolios to help them to build their long-term growth. And In the long run, it is the economic fundamentals that drive the market's returns, not a short-term political change. So by staying invested in a diversified portfolio reflected your goals, you're well positioned to benefit from both growth and stability as we navigate the new administrations. As StashAway, again, our general investing portfolio offers 12 risk different levels to fit your personal financial goals. I encourage you, if you haven't already started, to explore our general investing portfolio today to find an option that aligns with your portfolio profiles and objectives. And if you're still not unsure that which ones that you should want to really look into and that would be fit into your personal financial goal, feel free to book a one-on-one conversation with our team. We're here to help you to explain and then help you to choose your own portfolio that fits your financial needs. So in the next slide, you will find our QR code that you can scan. That in here you can make a one-on-one sessions. This offer to all our all the country in different regions that we will have like our client engagement teams to reach out to you to schedule us to talk to you about all the offering that we have in our platform. And of course, like all our other webinar, we will offer free investing for 3 months by applying the code next slide, or a promotional code Invest 2024, Invest 2024, that you will have free investing for all regions for the new funds for 3 months. And I will let this slide stay here so for people who continue to scan while we look at all the Q&As that to see what other answers that from our audience that we can answer.
Yeah, so I think I mean this is great. We would encourage if you have too much cash in the bank, I mean now is a good time to make use of this QR code to take advantage of free investing for 3 months. And I mean there's plenty of opportunities or options, as Janet mentioned, on StashAway for you to choose from. So we actually have a lot of questions. I hope to go through most of them, but I see that we're running slightly behind, so let me try to go through them, I guess, and address some of these comments or questions. Firstly, we've got Noel from YouTube, and Noel has 2 questions. Number one is based on Trump's first term as a president, is it a good indicator of what's to come, or has market conditions changed? So I think there are, I mean, depending on what aspect of Trump you're looking for, if I'm thinking from kind of just a purely market perspective, I think actually if you look at Trump's first term, there were, of course, a lot of ups and downs, a lot of like volatility in terms of, oh, what kind of trade policies he's going to impose. However, if you look at market reactions at the end of the day, a lot of policies that he enacted, mostly the tax cuts, was actually very, very pro-growth, pro-business. So I think that side would probably continue. And as investors, I think you need to kind of cut through all the noise to see, I mean, what is the actual impact on the economy. Second question on tariffs, and the question here is, how does it affect economies overseas? And also, I have another question on tariffs as well, basically asking about who will pay the tariffs, and is it the countries that would export to the US or US companies that take the imports? So if you think about tariffs as a very simple thing of adding on a additional price to a certain goods, of course, like different, I guess, different components or different aspects of the supply chain gets impacted. So first of all, a company may choose to pass on the price, or they may choose to actually take up the price in terms of lower margins. So it could impact the exporting countries, the trading companies in the US, and of course, it can affect the consumer as well, right? Because companies that sell very in-demand goods, they can actually raise prices. So I think the impact, depending on different goods, but it actually have a much wider impact through the whole supply chain and also through the consumer. Now, of course, the economies overseas have different tools to counteract this. And one thing that I mentioned is the currency. The second one is also the overseas economy may actually impose kind of restrictions on US imports as well. So basically what we call the trade war back in 2016. And I think, as I mentioned, I mean, this time around, hopefully, Trump is surrounded by more kind of pro-business advisors that could mitigate the impact of trade tariffs. And we have been through it before, right? We have seen in 2016, actually, the net impact of tariffs is actually much more lower than what the headline would suggest. Of course, when you read the news, like the media likes to talk about the tariff because it's a great story. But in reality, I think immigration is a much more potentially negative impact policy. And I guess we have also a question from Anonymous asking about gold. So, I mean, as you all know, I mean, we actually have a positive view on gold for, I guess, since we had the inflation regime coming in. And the question is there a target price for Stashaway on gold? We actually don't put out target prices for any of the assets because, I mean, when you look at target price, most of the time it sets a time frame, like 12-month target price or whatnot. And the way we manage our portfolio at Stashaway is that, I mean, we basically look at what the current economic regime is by looking at the current data, and we optimize our portfolio to the sense that, I mean, basically it provides you with the best risk return under this certain regime. So, I mean, it doesn't matter what our like standalone target price for S gold is. Let's say if our if in a certain regime, actually equities perform better than gold, or in a certain regime, like a recession, bonds would perform better than gold, then I mean, euro would actually over allocate to bonds compared to gold. But today, what we're seeing is that, I mean, gold still provides a very, very good risk reward, and most importantly, is a very good defensive asset to balance out the risk of equities. Because typically, when we see a equity drawdown, particularly in an inflationary environment, when equities go down, I mean, gold would actually go up. So that is actually why we include gold in our portfolios. Another question in terms of, I guess, U.S. markets. This question is about whether the U.S. market is an early, mid, end cycle of a new uptrend. I think it depends on what part of the U.S. market you're looking at. Obviously, we have had already a very big run up in big cap tech names, the Max 7, for example, and they're trading quite expensively. So I would say that for those, I mean, perhaps it's sort of like a mid to end cycle. And but also, I mean, what I've shown in the slides is that there has been a rotation out from these big cap names into value stocks, into smaller caps, mid caps, based on the election results. So for the rest of the S&P, I mean, a lot of them are actually still in early mid cycle. So I would say that basically you're seeing a rotation. So net, the index. The great thing about being invested in the index is that you always benefit from the sectors that are that the money is rotating in. So basically, I think you would still benefit from the early uptrend in terms of cyclicals if you stay invested in a broad U.S. equity index. Of course, like we have the equal weighted index because that would actually give even more weight to these earlier cycle companies. And then also, what are the catalysts for U.S. and European markets to go higher? And this anonymous attendee actually noted that the U.S. will have large budget deficits and inflation. And I think, I mean, we've walked through that, where we think that actually the U.S. will have bigger deficits and inflation over the longer term. The longer term, we're talking about perhaps in the next 10 years. In the near term, at least in the next 6 to 12 months, we think that the Trump policy will be supportive of growth, and equities actually like higher growth. And if you think about the inflation and growth, inflation, when it's not too high, or when the Fed is actually providing enough liquidity, equities would actually benefit from inflation, because at the end of the day, when you're buying a stock, you're buying it in nominal terms. So, for example, if a company has to raise prices because of inflation, that means in nominal terms, its earnings would actually go higher. So that's why in nominal terms, your equity price would actually go higher. Of course, like you have to, when you think about the return, you have to think about it in real terms. So if you take out inflation, you're getting additional returns. But at least when growth is robust, I mean, equities actually benefit from like slightly higher inflation. And then also again, related to ERA, there's one question from Shanem asking, how does the outlook translate into ERA portfolios? For example, if somebody has a conservative moderate risk tolerance, should they rotate into a more aggressive portfolio given our projection? So I think if you think about the statutory portfolios, we're constructed with two kind of axes or two components. The first one is your strategic asset allocation according to your risk appetite. And I mean, this is much more longer term. So it depends on two things when you choose your SRI. It depends on number one, your time horizon for investing in that particular portfolio. So for example, if you're investing for retirement, then I mean, and it's, for example, it's a 30-year time frame, then you can afford to have higher risk than if you're saving for something that is only 2 years away, or if you're already retired. Second axis is your own risk tolerance, right? Can you sleep at night if there is a drawdown? So for example, if you cannot sleep at night with a 20% drawdown, then maybe 20% SRI is slightly too risky for you. So you have to take into account these two considerations. And of course, in our platform, we try to help to guide you. And I think, I mean, our team is here to help you to choose the right portfolios as well. So that is something that don't change unless you're setting up new goals or your live event actually changes. The other part of ERA is basically the regimes, right? So the reason why you don't have to worry about the regimes is that our system, our investment team, I mean, we worry about the regimes for you. So we manage the SRI portfolios according to the regime. So we already would rotate within the statutory portfolios when the regime changes. So here, for example, in April, during the transition from a stagflation to an inflationary regime, we increase our allocations to equities for all of our SRI portfolios already. So already you're benefiting from the robust sort of upside in terms of equity market. So as I mentioned, a lot of people try to sort of time the ERA portfolios. I mean, I think that's a better way to think about it, is to think about your own strategic goals and timeframes. I think we still have a lot more questions to go through. So I think let me try to maybe answer one or two more. And unfortunately, I think we'll have to maybe come back to the rest of the questions. So one question from Anand on fixed income portfolio. The question is, how should we position our fixed income portfolio in the new Trump era? I have not seen much returns even after the interest rate cuts. So I think here again, because it depends on the portfolio. Typically, a fixed income portfolio has a longer maturity, meaning that you're basically lending money to people for longer. Let's say, 6-7 years typically for a fixed income portfolio, and perhaps if you kind of like you buy longer dated treasuries, you can lend up to 30 years to the U.S. government. And remember, there's like one slide where I show I guess the reaction of the 10-year treasury post the first rate cut. And after the interest rate cut, even though the Fed cut by 50 basis points, the longer maturity bond yield actually did not come down. It actually went up. And when you invest in bonds, your price and the yield actually is in reverse. So if yield goes higher, the bond price actually comes lower. Now, this actually all doesn't matter if you hold your bonds to maturity. So i.e., if you don't care about the fluctuations during which you hold the bond. So at the end of the period, so one thing, fixed income is called fixed income because you get a fixed coupon at every fixed interval. It can be monthly, it can be quarterly, but you basically, the concept is that you lend money to somebody. Let's say you lend $100 to somebody, and that somebody pays you a fixed coupon, let's say $6 every year in monthly payments. At the end of the period, if that somebody does not go bankrupt, he will pay back you that $100. And the reason why during the middle there is fluctuation in so-called bond prices is because the interest rates, there are like people who are trading in between the maturity. So if interest rates go higher, it means that there are better options out there. You can actually get a new bond with a high coupon. That's why prices actually comes down. So depending on whether you're planning to hold the bond to maturity or not, you may not care about the prices fluctuation in between. What matters most to a fixed income investor is, are you still getting that coupon? And does that coupon actually satisfy your cash needs? Because you're investing in fixed income for that fixed coupon. So yes, it's a long answer to this question, but I think there are. So when you think about fixed income, you need to think about the longer term inflation rate. Is the coupon going to cover your inflation rate? And also, is it going to pay for whatever expenses that you're planning? And the fluctuations in the middle actually does not matter for most fixed income investors unless you plan to trade the bonds around. I think, okay, maybe one more question. I think I've
Stephanie,
answered.
maybe while you're answering, I saw there's one that is asked about outlook from the JP Morgan fixed income bond portfolio. So this one I wanted to share that actually for those that who investing into this portfolio, we do share the monthly update from time to time. But there is actually an outlook share with them that they're from JP Morgan perspective, they do for bond markets, meaning that still remain positive in a way that they're like what Stephanie has mentioned earlier, that they do believe that the robust, the economic cycle is supportive in terms of for those that who lend the money to you, they're able to return the money to you. So from that angle, they really consider is still healthy. And then, but in terms of the portfolio, the current positioning is around duration of 4 years, which we consider is like a medium or short to medium short duration, which is actually help to balance the fluctuation for the market movement. At the same time, they have recently rebalanced their U.S. aggregate bonds into the EM weighting. So it means that they're trying to take advantage of the economic cycle environment so that they will be able to get some yield from different sub-asset class within the portfolio. So this is a brief update from on the JP Morgan portfolio, but which of course there will be a constant communications every month to send to those that who are holding the portfolio.
Yep.
Sorry, back
Thank
to
you.
you.
No worries. So I think there are a few questions on ex-US, so maybe I'll just address those as well, right? So I mean, what does this mean for other countries? So for example, China, and also I've got a question on Japan and India asking about valuation. So firstly on China, I think what I've mentioned was we're waiting for policies that are directly stimulative to consumers. I mean, one reason why Stashaway has I guess maintained a market weight in China is because I think when we looked at the systemic risk in China, or a few months ago, we published a CL Insight looking at whether or not there is actually much bigger concerns in China. And the conclusion was that because if you look at the banking system, it's actually still quite healthy. As long as the banking system is healthy, the government can actually, I guess, control a lot of the slowdown in real estate sector and also kind of control the, I guess, a slowdown in unemployment. What ERA also sees is that based on the data, the recovery has been very, very muted. And in fact, if you look at China, China has been suffering from a deflation problem. And recently it's gotten better, but it's also like very, very slow. And when you invest in China, because the risk is so much higher, so the growth prospect also needs to be higher to justify a over allocation to China, even though we all know that it's quite cheap. So I think what we're kind of hoping for is that if the Chinese government actually comes up with much more forceful policy, the next potential time frame is actually in December, where they have the Economic Work Conference, and that could be more stimulative to actually make the Chinese data recover. Then ERA may take a more aggressive stance. But right now, the data is not just suggesting that's a quick turnaround. On the other hand, if we look at places like Japan and India, even though yes, valuations are quite expensive, but I think if you look at the reason why investors put money into equity markets is because of growth. And India still offers the best kind of structural growth from both a historical time frame and also if you look forward, PMIs, for example, for India has been consistently tracking the highest among a lot of economies. So India still offers the best kind of, I guess, domestic growth story in the region. From a Japan perspective, I think, yes, I mean, it's been quite choppy this year, largely because positioning was actually quite crowded in the Japan trade. But I mean, what we like about Japan is that if you look at Japan itself, Japan went through a 30-year deflation, and this is something that China is trying to fight. And the latest data shows that Japan has indeed emerged from a deflation. For such a big economy to emerge from a 30-year deflation is actually a very, very significant event. And you see global investors actually starting to allocate back to Japan again. Of course, like Warren Buffett was very, very early on. We're seeing actually more foreign investors putting money to work in Japanese companies. And also, depending on how you look at Japan, I mean, Japan companies are still actually very, very cheap from a longer term PB price to book basis. So there's still a lot of room for, I think, Japanese corporates to increase their earnings and therefore a lot more room for the Japanese equity to run. So, I mean, that's why Stashaway ERA portfolios are kind of overweight in both of those geographies. So I see that it's getting late, and I think a lot of people have to kind of go off for dinner. And Janet and I perhaps would just like to thank you, everyone, for spending the night with us, spending a precious moment with us. Hopefully, we've addressed a lot of the questions that you have on the mind about the election outcomes, Trump policies, and apologies for not answering all the questions. I mean, we'll try to get back to you. But again, thank you so much for being with us and being supportive of Stashaway. And please be sure to make use of this QR code to put your cash to work.
Thank you, everyone. Have a good evening.
Thank you. Have a great night.